You work hard, save, invest, but still don't see your wealth growing as you'd like? It could be that your money is stuck in the wrong places. Today, I'm going to reveal 10 assets that seem like good choices, but that could actually be sabotaging your path to wealth. If you want to build a solid financial future, you need to avoid these mistakes at all costs. Before we get started, subscribe to the channel and activate the notification bell so you don't miss any content that can transform your finances. Ready? Let's go. I'll start with a slap in the face. Your financial plan cannot depend on luck. Imagine you're in the middle of the ocean, in a leaky boat. Each lottery ticket you buy is like scooping out a bucket of water, thinking you're solving the problem. But the hole is still there. And guess what? With each new bet, the hole gets bigger. The truth is harsh, but I'll say it anyway. You're not playing against luck, you're playing against mathematics. And mathematics doesn't feel sorry for anyone. Want an example? The chance of winning the Mega Sena lottery is 1 in 50 million. It's so small that you're more likely to be struck by lightning, be attacked by a shark, find a gold nugget in your backyard. Yet millions of people line up for miles every week to try their luck. But what happens to most of them? They lose, always. It's a disguised tax, levied on people who don't understand probability. Now, I know what you might be thinking. Oh, but one person won and became a millionaire. Yes, and how many millions of people have played and not won? These success stories are bait. The system needs a few winners to keep the illusion alive. It's like a casino. When someone hits the jackpot, a little music plays, and everyone cheers. What no one shows is the army of losers leaving with their heads down. And speaking of casinos, there is no such thing as a fair bet. All games are designed so that, in the long run, the house always wins. That's why Las Vegas casinos are gigantic and full of lights. They weren't built with the winner's money. The same goes for sports betting. You might even win a few times and feel that taste of victory, but the algorithm already knows that. It gives you small wins at the beginning to keep you in the game. And before you know it, you've already spent much more than you won. If getting rich were a matter of luck, the owners of lottery shops, casinos, and betting shops would be the poorest people in the world. But look around. It's always them who get rich, never the players. So if you really want to get out of the rat race, the first thing to do is simple. Stop gambling and start investing. Number 9. Car as an investment. You know that incredible feeling when you get into the car of your dreams? The new smell, the shiny dashboard, the powerful engine that makes you feel on top of the world? Well, that's the exact moment when you start losing money. The moment you leave the dealership, the value of your car has already dropped, and it continues to depreciate every day, even if you hardly use it. You can take care of it like it was your child, wash it every week, fill it with the best fuel, but it will never pay you back in cash. Let's look at the numbers. Let's say you buy a car for $50,000. As soon as you leave the dealership, it could be worth $42,000 or less. After a year, maybe $37,000. 5 years later? If it's still worth $25,000, you can consider yourself lucky. Half of your money has simply evaporated. Now, if you finance that car, things get even worse. In addition to depreciation, you are paying interest, bank fees, and taxes. In the end, that $50,000 car could have cost $65,000 or more. And the costs don't stop there. Insurance, because accidents happen. Taxes and fees, because the government never misses a chance to charge. Maintenance, tires, oil, parts, everything has a cost. Fuel, an endless expense that only increases. In other words, if you think a car is an investment, think again. An investment puts money in your pocket. A car takes money out of your pocket every month. Now, calm down. I'm not saying you should never have a car. I know that, for many people, it is a necessity. But if you are going to buy, do it in the smartest way possible. Buy a used car, one that has already gone through the greatest depreciation. If possible, pay in cash to avoid interest. Choose an economical and reliable model that will not give you a headache, because the only thing worse than spending money on a car is spending money you don't even have. Number 8. Capitalization plans. Imagine you're walking down the street and you come across a flashy poster. Save money and compete for incredible prizes. It sounds like a great deal, right? But here's what no one tells you. This prize has a high price, and the real winner is the bank. These banking products work as a kind of mandatory savings, where you make monthly deposits and at the end you get your money back. But there's one detail. There's no real interest and it's eroded by inflation. In other words, you spent months or years giving your money to the bank for free. If a bank offers you something like this, it's because they're winning. Banks aren't charity. While you leave your money there, they're investing that same money and making a profit from it. They take your money, make it grow, and then give it back to you without any real return. Want a practical example? Imagine that you deposit $300 a month in this type of program for 5 years. In the end, you get back the same $18,000 you invested. Sounds good? Now consider inflation. If inflation averaged 3% per year, your money lost purchasing power. That $18,000 today buys much less than when you started saving. And you know what the worst part is? If, instead, you had invested that money in assets that actually generate returns, such as stocks, funds, or even a smarter fixed income, you could have multiplied that value. Avoid banking products that promise rewards. The only guaranteed reward is the bank's profit. Invest your money in assets that make it grow for real. If you need an emergency fund, choose an investment that at least keeps up with inflation. Idle money is not safe money. It is lost money. Number 7. Cheap and low-profit franchises. Imagine that you are excited about the idea of having your own business. You see a famous franchise and think, this must be a guaranteed success. After all, the brand is already known. It has a ready-made model. All you have to do is follow the rules and wait for the profits to come in. But wait, what if I told you that, for many franchises, the real business is not selling products or services, but selling franchises to people like you? That's right. Some franchisors make much more profit selling the right to use the brand than from the business itself. They charge a very high initial fee, require a heavy investment in structure, and then keep a good part of your revenue every month. And you assume all the risk. If the franchise were that profitable, why don't they open more stores themselves instead of selling to third parties? What no one tells you about many franchises. Expensive franchise fee. You pay a high initial amount just for the right to use the brand. Monthly royalties. Every month, a portion of your revenue goes directly to the franchisor, regardless of your profit. Strict rules, from mandatory suppliers to marketing campaigns that you have to pay for, even without a guarantee of return. Lower profit than it seems. When you add up rent, employees, taxes, and franchisor fees, you often end up with very little left over for you. And the worst part? Many franchises sell you unrealistic profit projections. They show you pretty numbers, but they don't tell you that most franchisees take years to recover their investment, if they recover it at all. Does this mean that all franchises are bad? Number. Some really work and generate good results, but you need to analyze it coldly before investing. Talk to other franchisees and ask if they are really making a profit. Read the entire contract carefully and understand the hidden costs. Do the math. After all the fees, how much is really left at the end of the month? Because if you don't analyze it properly, you could end up being just another employee in disguise, working for free to enrich the franchisor. Number 6. Funds with abusive fees. Imagine you are hungry and walk into a famous restaurant. The menu promises an incredible dish prepared by the best chef in town. You order, pay a lot, and wait anxiously. But when the waiter arrives, he puts in front of you a plate of instant noodles. This is exactly what happens with many investment funds. They promise sophisticated strategies, but in the end, they deliver a basic return and still charge a lot for it. The problem? The fees eat up your money before the market even has a chance to grow. What are you really paying for? Management fee. You pay just for the fund to exist, even if it performs poorly. Some charge 2% per year or more. Doesn't seem like much. Over time, this can cut a huge slice of your earnings. Performance fee. A bonus for the manager if he outperforms a benchmark index. It seems fair, but often this index is so low that he earns even when the fund only had an average return. Entry or exit fee. Some funds charge you to enter or exit. This means that you start losing money before you even invest. Now let's say you put $100,000 into a fund that charges 2% annual management fees. If the fund earns 7% per year, you don't get that. After the fee, your return drops to just 5%. Now add in inflation, which could be 3% per year, and voila, you've barely earned anything. And the worst part? Most mutual funds lose to the market in the long run. Studies show that if you simply invested in a low-fee stock index, you would outperform most professional managers. Number 5, properties that only generate losses. So you've just bought a property. The keys are in your hand. You smell the fresh paint and think, now I'm safe. Properties always appreciate in value. But then the bills start to arrive. Condominium fees, maintenance, notary fees, possible renovations, and if it's a rental investment, you still have to deal with tenants who may be late in paying, causing damage or simply disappearing, leaving you with months of losses. Suddenly, that dream of guaranteed passive income turns into a financial nightmare. And the worst part, you can't just press a button and sell the property the next day. The myth of guaranteed appreciation. Many people buy properties believing that they always appreciate in value. But the truth is that this is not the rule. There are neighborhoods that lose value, buildings that age, and real estate markets that go into crisis. If you buy in the wrong place at the wrong time, you could end up with an asset that depreciates instead of growing. Now, let's do the math. You paid $300,000 for the property. Your rent is $1,500 per month. Sound good? Now subtract property taxes, condominium fees, insurance, maintenance, and periods without tenants. If, in the end, the return is lower than other safe investments could give you, you bought a liability, not an asset. Does this mean that real estate is a bad investment? No, but you need to know how to choose and how to invest in real estate the right way. Calculate the real net return. Don't be fooled by the gross rent. Consider the location and demand before buying. See if the real estate market in the region is growing or stagnant. Consider other options. Real estate funds can be a more efficient way to invest without the headaches of a physical property. Because investing without doing the math is like buying a house without looking at the land. You may find that when you open the door, you are going underwater. Number 4. Companies on the stock exchange. Some people invest in the stock exchange as if they were collecting relics. They look at a company that was once a giant and think, if it was good, it can be good again. But the financial market does not reward nostalgia. Think about companies that dominated the world and today barely exist. Some were synonymous with innovation, but fell behind because they did not keep up with the changes. Competitors arrived with new ideas, consumers changed their habits, and suddenly, that once unbeatable company became just a memory. The problem is that when a company goes into decline, there is no guarantee of recovery. Many even try, launch new products, make cuts to save money, but if the market has already turned the page, none of this helps. And in the meantime, those who bought their shares hoping for a miracle see the price melt. How to avoid falling into this trap? Look forward, not back. A company may have made history, but what matters is whether it still has room to grow. If a stock has been falling for years, find out why. The market doesn't abandon profitable companies without reason. Prioritize innovation and adaptation. The companies that dominate the future are those that evolve, not those that live in the past. Putting money into declining businesses hoping for a rebirth is like buying a ticket to a Titanic that has already sunk. Number 3. Dubious cryptocurrencies. The cryptocurrency universe is a real financial Wild West. For every serious project, there are thousands of scams waiting to rip off the unsuspecting. If someone tells you that a crypto is going to explode, stop and think. If it were so guaranteed, why are they telling you? The people who really profit from these trendy coins are not making videos promising fortunes. They get in early, make noise to attract investors, and when the price goes up, they sell everything. Who arrives last? They are left holding the loss. Many of these projects come out of nowhere with promises of revolutionary technology, secret partnerships, and a bright future. But when you look closely, you discover that the website was created last week, the developers are anonymous, and the only thing they have really done is convince thousands of people to buy. Does this mean that all cryptocurrencies are bad? Of course not. Bitcoin, Ethereum, and other serious cryptos have real fundamentals and technology behind them. But before investing, follow 3 basic rules. If someone promises guaranteed profits, run. In the world of investments, nothing is guaranteed. Study before investing. If you don't understand how it works, you're gambling, not investing. Don't get carried away by the hype. What goes up quickly without foundation usually goes down even faster. Because falling for crypto scams is like buying tickets to a show that will never happen. You pay a lot, believe in the show, but in the end, the stage is empty, and the organizers have already run away with the money. Number 2. Fake passive income schemes. Earn 10% per month without doing anything. This phrase has fooled many people, and the logic behind it is simple. Who doesn't want easy money? But here's the truth that no one tells you. Real investments don't work that way. If a traditional bank offers something like 5% per year, how can anyone promise 10% per month without risk? The secret is that they can't. And when someone promises you this, you're not investing. You're buying into a scheme designed to collapse. And how do these scams work? Most of these scams follow a classic pattern, known for over a century: the Ponzi scheme. It works like this. The first investors join and start receiving payments. This creates a false sense that the system works. New investors are attracted by the success of the first ones. Their money doesn't go to real investments but to pay off those who joined earlier. The scheme grows until it can no longer sustain the payments. When new deposits stop, the money disappears and the scammers disappear. It's always like this. Always. But how do you identify these traps? Promises of fixed and high returns. The real market is volatile. If someone guarantees absurd profits, they're lying. Lack of transparency. If they don't explain where the money comes from, it's because it comes from new investors. And that's a pyramid scheme. Pressure to refer more people. If the model depends on you bringing in new participants, it's a scam. These schemes always fail. They always leave victims. And the only one who really profits is the one who created the fraud. Falling into this is like going to a casino where everyone wins at the beginning, but in the end, the house always takes everything, and you leave without a penny. And finally, the biggest enemy is the lack of financial education. The worst asset is not a bad property, a declining stock, or a Ponzi scheme. It is financial ignorance. It is treacherous because you don't even realize you have it. It makes you believe in absurd promises, follow the wrong advice, and make the same financial mistakes over and over again. Worse, it makes you think that money is just a matter of luck, when, in fact, it is a matter of strategy. Those who don't understand money will always be controlled by those who do. Banks profit because you don't know how rates work. Financial pyramids grow because people believe in easy gains. The market takes advantage of those who buy at the top and sell in desperation. But here is the good news. You can get out of this cycle. The difference between those who prosper and those who fall behind is not the amount of money you earn, but what you do with it. And that starts with knowledge. So you ask, how can you change this? Read about finance. You don't have to be an expert, but understand the basics. Question everything. If someone promises you something too easy, ask yourself, where does the money come from? Learn to really invest. Don't throw money at something just because it seems popular. Financial ignorance is costly, and the bill comes for those who aren't prepared. But every conscious choice you make today could be the difference between a future of financial freedom or a lifetime of money problems. The decision is yours. Now you know which assets are the worst at destroying your wealth. The question is, what are you going to do with this information? Will you continue to fall into these traps, or will you take control of your finances and build a solid future?